So let's start out with meeting, learning about Daniel. So Daniel is a searcher, um, and Daniel had a crisis. So Daniel was a search for a year for the perfect acquisition. He found a commercial cleaning company with strong fundamentals, solid contracts, um, and consistent EBITDA margins. What the financials didn't reveal to Daniel was some of the things we're going to talk about today. So, what Daniel saw was revenue trends were stable and predictable. Um, the margins remained steady. EBITDA looked strong quarter after quarter. Uh, what Daniel missed was the receivables were aging beyond normal terms. Payables were accelerating faster than collections, and monthly cash requirements had steadily increased. Uh, Taking a step back, Daniel did negotiate a working capital amount in the deal to be delivered at closing. We'll get to the stipulations around that, and if you have questions, I'm happy to answer it, but just keep that in mind. But Daniel, given some of the things Daniel was uncovering during due diligence, um, he asked the seller and broker about working capital, and they reassured him, working capital isn't a big deal. We'll take care of it. The business isn't cash heavy. It doesn't take a lot to run. So, you know, where are we going with this? And here is the 250K bombshell, as I call the shocking gap. So a sudden 250,000 working capital deficit was uncovered, significantly more than the seller's pre-closing provision. So Daniel was in crisis. Daniel was what I refer to as he entered a cash shortfall, a cash shortage. The working capital he was delivered at closing could not meet the cash needs of the business. Um, so what is he to do? Without cash, it meant that there's operational paralysis, payroll wouldn't clear, vendors would go unpaid, and the business would grind to a halt on day one. Um, the true failure with this and Daniel's story is this happens frequently in these SMB deals and the ETA space. Um, the cash needed to working capital is effectively the cash to continue business operations. And without it, the business grinds to a halt. So while the true failure of the deal wasn't the great deal, it nearly collapsed because Daniel failed to accurately assess working capital during those crucial early and closing stages of this business acquisition. Um, so what's the solution? How can you avoid like Daniel's situation? Um, Effectively, this is the crux of what the working capital analysis looks to aim at. It looks to analyze operating assets and liabilities, identify trends and seasonality of the business, and set a working capital peg early. The working capital peg is effectively the dollars that, it stipulates what is the working capital dollar amount the seller will deliver to the buyer at closing. So, two questions I'm often asked. One, the sellers and brokers don't want to include working capital in the deal. If that's the case, you either need to negotiate with them that you would like that to be included. Otherwise, this working capital analysis and PEG is not applicable to your deal. Unfortunately, there are many sellers and brokers who aren't willing to provide working capital included in a deal. If that's the case, I would work with them to educate and understand, why you need this, because effectively it's the gas that, powers the car. It's the fuel and, for the engine of the business. Without it, you either need a significant amount of cash bringing to the business when you assume duties as the new owner, and or other cash sources in order to continue business operations and sustain profitability. So overall, many buyers like Daniel, they focus on the profitability, but many times working capital is more important in these acquisitions to make sure you get these deals right. And they set up, for success. So Daniel's story is one that many can relate to. I've spoken with hundreds of self-funded searchers and acquisition entrepreneurs, and working capital is something that comes up often, which is why I'm asked so many questions about it. So let's dive into what is the working capital evaluation? Effectively, it analyzes the company's liquidity and short-term financial health. It assesses the operational funding needs to maintain day-to-day activities. Think payroll, um, fixed costs such as rent, utilities, etc. Um, Perhaps the cost of goods sold and the direct costs in order to drive revenues. The working capital evaluation also identifies seasonal or cyclical variations in working capital requirements or the cash needs of the business. Um, while working capital typically is excluding cash and debt, it very much shows the inflows and outflows of the business. Think accounts receivable and accounts payable. And ultimately, the working capital evaluation ensures there's adequate resources and an amount that is required in order to continue a smooth business transition. That's really the whole point of this. Um, the number one risk to an ETA buyer is overpaying for a business. And the number two risk is, in my opinion, is not getting enough working capital to continue sustainable business operations. Um, Without an appropriate level of working capital, you risk the business grinding to a halt. And what doesn't grind to a halt is those monthly SBA loan payments, which you are required to make. I've seen disaster scenarios where a few ETA buyers have actually lost their businesses within the first 90 days because of this working capital and cash crunch. If certain situations trigger, the SBA could basically default on your loan if you fail to make payments due to a cash crunch if it occurs. So let's take a step back. So what are some of the challenges that kill deals? So killing deals is before you do sign, and you'll see things like seller hesitation. There could be roadblocks with financing and liquidity gaps, um, valuation gaps, and overpricing. Number four is working capital. Believe it or not, um, many deals will break um, and or die because of these working capital discussions. And the fact of the matter is, um, many SMB sellers and brokers don't like the idea of delivering working capital. They don't understand, why you should be getting it. In their minds, the business valuation should be derived on earnings, et cetera, et cetera. Needless to say, working capital kills deals frequently. So if you are under LOI or thinking about submitting as an active searcher, you need to have these working capital discussions early and often. Early meaning if you want working capital included in your deal, you should discuss that. And you should discuss what it looks like. What is it going to be comprised of? Is it going to be accounts receivable? Is it going to include inventory? Is it going to include cash? Typically not. It may include cash, but typically not. Other current assets. Uh, a couple things I see pushback on is the idea around sellers will say the following. Well, I already purchased I already purchased, uh, I already paid for the goods, so I'm owed those accounts receivable. And that might be the case. They make a fair point. Um, but the challenge is most of the time, your primary uh, your primary working capital is going to be in the form of, these accounts receivable. So let's break down the calculation of what working capital is. And while we're doing that, I'm going to launch one more polling question. Um, so how confident do you feel in your ability to evaluate a business for acquisition? Scale of 1 to 10, 10 being yes, 1 being I don't know where to start. Let's see what we got. So about 50% say 7 or 8, which is excellent. A couple brave souls said 2 or 3. No worries at all. Evaluating business acquisitions is something that comes with repetition. The more businesses you evaluate, the better you'll get at. As someone who does this for a living, I probably would rank myself as a 7 or 8 as well. So I'm certainly not a master, but I appreciate the honesty. So working capital, it measures the difference between a company's current assets and current liabilities. So what are current assets and liabilities? Think accounts receivable, inventory, other current assets. What are current liabilities? Short-term debt, accounts payable, and accrued expenses like payroll, um, and other expenses. The calculation of working capital is effectively current assets minus current liabilities. So here we go. Here's a quick run through of a working capital calculation. So as mentioned, it's current assets less current liabilities. So what you would do is you would effectively request a balance sheet on a monthly basis, and you would calculate the current assets, property, inventory, etc., less liabilities, wages, rent, utility, payroll, etc. That calculation is working capital. You'll see on the screen, it is included of cash. If your acquisition, and this will be stipulated in the LOI, is on a cash-free, debt-free basis, this working capital amount will be lowered by the cash and debt since it's going to be excluded. So really, if you think about it, what's left in a working capital calculation is often accounts receivable and accounts payable. In small business acquisitions, particularly, that's typically what I will see as the material components. So again, how do we get there? You first want to request these monthly balance sheets and put together this calculation. Um, from there, after you've assessed it on a monthly basis, you want to try to effectively select your working capital target amount. Is it going to be $95,000? Should it be something else? Depending on what the trends look like on a month-to-month basis, you should pick, the appropriate level. So I put together a business buyer's toolkit. Um, if you want a copy, it includes some of my best stuff. Feel free to scan that QR code. It has things like my due diligence checklist, commentary around working capital, stock versus asset sale, etc. To date, it's at 92 pages, which I'm proud of. I built this over the last, 5 or 6 years. Feel free to scan and grab a copy today. Should hit your inbox automatically. All right. So here's another example, and we're going to start getting into the meat of the topic of how to calculate this specifically. So, example two, picture this. You're under LOI for a consumer products business, and it's a fairly sizable business, 10 million in revenue, um, and it has receivables of close to $1 million, inventory of 1.3, prepaid expenses of 150K. Those three items are deemed current assets. So before we keep going further, in order to correctly calculate a working capital calculation, you need to understand what are current assets and what are long-term assets, what are current liabilities and what are long-term liabilities. If you don't know the differences, I'd encourage you to research around this topic and understand the differences. Um, because effectively we're focused only on the current items. And there's a variety of reasons why we ignore long-term items, but for this webinar, we're not going to go into those details. So assuming you understand what current assets and current liabilities are, we have things like accounts payable, accrued liabilities, and deferred revenue. So deferred revenue is a topic people will get hung up on. Again, this is when we start getting into the meat of the accounting lingo and the accounting jargon of like current liabilities. If the business receives prepayments um, ahead of time, those are largely considered deferred revenues rather than um, the revenues of the business. So think if you were paid 100K ahead of time to complete a project, uh, those would be deferred because you haven't earned them yet, and therefore these would be the current liabilities of the business. Um, so based on this calculation, we have current assets of 2.3 million, current liabilities of 1.7. From here, it's simply math. So think back to the calculation, current assets minus current liabilities, and we have a working capital of 600,000. So with that information, we need to ask ourselves, what should be the working capital peg? What is an appropriate level? So you can think of this example as a snapshot in time. It's very likely 1 month. You need to conduct this analysis over 12, 24, or 36 months. And with that, you'll see different working capital numbers. You might see 600,000, 800,000, maybe it drops down to 200, etc. Based on the averages, I like to use three averages: the last 3 months, the last 6 months, and the last 12 months. Based on the type of business and the growth of the business, you are very often going to select one of those three averages from your monthlies. My rule of thumb is if the business is growing rapidly year over year, you want to select a shorter average window. I would probably do 3 or 6 months. If the business is very steady year over year, you're probably fine using the 12-month average. Um, Working with a QV team and financial due diligence accounting firm, such as the one I lead, makes this process very easy because it is very accounting intensive. And using Excel and being able to plot and articulate your working capital peg is something we spend a lot of time on. So let's take a step back and think about the working capital timeline. So again, for those of you actively searching or under LOI, this is what it's going to look like. So you'll have your pre-sale preparation. So even for those just starting their search, you may analyze historical working capital and the historical trends of the business. You might receive balance sheets, you might receive income statements, etc. Uh, Once you sign your LOI, that is when you're going to establish the working capital target using the analysis we just discussed. From there, at the time of closing, you will then again use the same calculation in order to recalculate working capital. Depending on how your deal is structured, you may have a post-close true-up, which will calculate the closing working capital compared to what it was right before closing. So you'll see here the post-close true-up is typically performed 90 days after transaction closing. So let's use an example. If you were expected to close on 12/31, in your purchase agreement, the day before closing, you would calculate what is working capital at the time of closing, so at year end. Let's say it's $1 million. If you calculated the same amount 90 days after, depending on where that calculation came in, higher or lower, you could have a stipulation for adjusting the purchase price on a dollar for dollar basis. I'll get into specifics a little bit later, but that's the timeline. And that's why this calculation is so important. It effectively can be a dollar for dollar reduction of your purchase price if it's calculated and structured correctly. Typically, my firm will calculate the working capital, and a M&A law firm will draft the language to give you the rights for a purchase adjustment following the closing true-up. Again, the specifics around this are best discussed once you have something under LOI. If you want to work with your deal team, that would be my recommendation. So here are a couple other ways to think about working capital. Again, it's an assessment of the company's liquidity and the short-term financial health. Sometimes it's much easier to think about working capital as specific items. For small businesses, most often your larger current assets are going to be accounts receivable and inventory. Your largest current liability very often will be accounts payable. Third example. So we're switching gears and we now are under contract for a construction business. So construction businesses have a high working capital. I call it high working capital intensity. The reason why it requires high working capital is because these types of businesses have long project times, which result in greater accounts receivable and longer collection times, as well as the payables, when you need to pay your subcontractors, et cetera, may actually be sooner than when you can collect. So it's very important in project businesses, heavy construction, you get the working capital amount correct. Because without it, I've seen several cash crunches for these new buyers occur. So again, it doesn't matter what the business is. It's simply assets, current assets minus current liabilities. Looking at the above calculation, you'll see that there's 2.8 million of accounts receivable on the books at year end. It roughly represents 30% of this $10 million revenue business. So that's a significant portion. Again, in construction businesses, due to longer project times and collection times, it's not a surprise that accounts receivable is a higher percentage compared to other industries. think back to our other examples, it was significantly lower. Additionally, when you're thinking about working capital and your peg or your target amount, you want to understand what are the seasonalities. So for construction, what I've seen in practice is, depending on where you are in the globe, and in the US, the summer months have a stronger seasonality, and the warmer months very often, because that's when construction or road work is performed due to better weather, and to kind of gear up for those winter months, especially road work. Um, so depending on when you're purchasing the business, you want to ask yourself, what are the working capital needs of the business I'm stepping into on day one? And that very much depends on the month you're actually closing on the business. So keep that in mind if you do detect some seasonality, because it's something that can be costly. Um, Rounding out the last one, so there may be instances where working capital is negative. I call it low working capital intensity. This is often because things like software businesses, they do not generate large amounts of, items to substantiate, working capital. They may have a short cash cycle, etc. Um, so again, when you're thinking about working capital as it relates to your deal, take a step back, look at the balance sheets, and calculate the numbers accordingly. And then do some research around the type of business and the industry, and what are the cash needs of the business. More importantly, how is the business operational? Does it have 30, 60, or 90-day collection times? Are they paid in advance? Depending on the answers to those questions, it can give you a framework for, why am I doing working capital? Do I need to do it? And how does it relate to my deal? So the analogy I always use for working capital is like selling a car or buying a car. Think about working capital in the scenario of you buying a used car. You and the seller agree, um, to buy the car. You may even agree that, it'll include a half tank of gas, which could, in this case, could represent the working capital. You need this half a tank of gas in order to, drive home, make it back to your car. Um, you close on the purchase and you take the keys from the seller, but you start to drive away and you barely get a mile down the road, and the car sputters to a stop, and you realize you just purchased a car with no gas in the tank. Effectively, this is what working capital is. Working capital is the gas you need to get to your destination, to keep the car moving, and how your ability to receive the appropriate amount at the time of closing is as important as the gas you need to make it home after you buy a car. Despite seller and broker attempts to mitigate and lessen the amount of gas you need at the time of closing, stick to your guns, calculate it appropriately, and be firm in your asks based on the needs of the business. So, a couple more things as we're rounding out is helpful to know. So, what isn't working capital? So, what's not working capital are cash available to cover operating expenses in the near term. Cash and debt, typically not working capital. Why? Transactions are typically on a cash-free, debt-free basis. What are other considerations? The working capital should be defined. So in your purchase agreement, you should list any inclusions and exclusions of what working capital is. You should define, is accounts receivable working capital? Is it going to include inventory? Is it going to include payroll liabilities? Very much stipulating the exact balance sheet accounts and calculating it is best practice for these deals. And these should be considered and discussed with the sellers as early as possible. Without that, you avoid surprises. If you have these discussions early, I've seen success and the ability to receive these amounts at the time of closing.